All right. Hey, good morning, and thank you for joining in live. It looks like it is right at 7:30, so I think people are going to be dialing in here as we get going. But we'll just jump right into it. There's kind of a lot to cover, and I think the first thing that I want to talk about is start addressing last Thursday's action. Let me get these charts pulled back up here. If we look at last Thursday's action in soybeans, we saw the largest single decline in soybean history in a day. Okay, so soybeans were off over $1.25 on the front month, and they were off about a buck in the back months. So what drove that? And there's a lot of theories that are going out. I have one that I think explains it, and I think we got hit with a couple of things. First, you had lots of gamesmanship going on all over Washington D.C. Right? You had manipulation by the politicians regarding the RFS and trying to get some bailout to the refiners, and they really did that by talking down the RFS and collapsing the RIN market, which allowed the refiners to remove some of their liabilities off their balance sheet cheaply. And then I think what happened is all through this big long move coming up, right, all the way from $8, what you had was systematic selling of put options. So those of you that aren't real familiar with put options and option Greeks, let me explain kind of what happens in a move like this. And this happened in natural gas a couple of years ago, and I think this explains the slope of this move here, because nothing's changed fundamentally, right? We're still hot, we're still dry, we've got issues, we've got really tight balance sheets, we've got no margin for error. All those things were true here, and they're still true today, and they're definitely true on Thursday. So what happens? Well, when you sell an option, you are selling a derivative, and that derivative is priced according to two things. Its price is determined by its relationship to its strike price. So whether you sold a $13 put or a $12.50 put or a $12 or $14, right? And it's priced in terms of volatility. Now, if those of you that have been around me a long time know that we talk a lot about delta in this office, and delta is a percentage factor. So if you buy a put and the price of beans drops 10 cents and your delta is 50, then your option is going to increase by 50% of the move. So if price drops 10 cents, your option is going to go up 5 cents. Okay, that's called delta. I call it the percentage factor. It's the net percent you are that you'll capture of the underlying move. There's another Greek called gamma, and gamma is the Greek symbol that quantifies the rate at which the delta changes of an option. Because if you buy a 1450 put, let's say, and you bought it right here, your delta was going to be 0.5. But as you drop down to here, your delta gets higher. So by the time we get down into here, your delta is going to be closer to, call it 0.8. So you're going to be 80% effective down here. And the rate of change that the delta increases is called gamma. And when you sell thousands upon thousands of puts all the way up into this rally, and funds did it, China did it, they all did it, because if you sell a put, you collect the premium, and then if you are buying the cash, you've effectively pushed the market higher, collected the premium, and lowered your sale price. So they've been selling tens of thousands of soybean puts all the way up. And so when this move started to happen, what started occurring is their delta on their puts started getting out of control, because they were getting crushed by excessive gamma that they had. Okay, And this is what causes this big slope to happen here, because what happened on Thursday was really interesting in the futures markets. So if you look at if you look at an options chain, okay, this is an options chain of November soybeans. What you can see here are bids and asks, and you can see relative security here. So I can buy a $13 soybean put for between 85 and 86. Okay, so you've got a relatively tight bid ask. And this is what you rely on to have a good to have an orderly market. Last Thursday and really a lot of Wednesday too, these bids and asks were not lining up, and so there would be as much as $1 difference between the bid and the ask on all these options. So the options market, especially in soybeans, just completely froze and didn't perform. And I think what was happening, well, I don't know why it did what it did and didn't work, but the reality is the people that had sold these options, they couldn't do anything to cover them. So they're getting gammoned to death, and their options are just spiraling out of control. And so funds were getting blown out. And so what happens in the big world of big traders is they don't get the next day or 2 days or 3 days to make a margin call. They get to make it in real time. And so they either had to buy their options back in, they had to get coverage somewhere else, or they had to sell futures. And as the futures tumbled, they had to sell more and more futures to offset their gamma risk that they were getting underdone. So I think that that's what caused this. It was just a self-fulfilling prophecy. It had nothing to do with fundamentals. I think some funds just got hammered, and the algorithms piled on top of it. So this is what happens in electronic trading when you're short puts, and then that spilled over into everything else. That's my theory, because nothing else changed here fundamentally. I mean, we have some things that are kind of out there floating around the news, and a lot of it's coming out of China. Like, oh, hey, they say, oh, we don't have any food problem, we're good. Oh, we've got congestion in our ports. Oh, we've got a COVID outbreak in our ports. We can't import anything else. And then they turn around and buy 10 cargoes. So you can't listen to what China says. You can only focus on what they do, which is they buy breaks. They buy breaks and they reload and they keep doing it. The other thing that I read yesterday that was just total fake news, or maybe I read it this morning. I read, the South American and the North American ethanol producers have jointly agreed to slow down ethanol production because of high food prices. That's just BS. There's absolutely no truth to that whatsoever, because the ethanol margin is fat. It's wide. Gasoline demand's going up. Gasoline prices are high. Oil's screaming through the roof. People are flying around driving like crazy, and they're burning ethanol. They're not going to slow down the grind. That's nuts. We haven't rationed a single thing. So whoever it is, they create these headlines and they kick them out so that their algorithms can trade it. And I think that that's going to become more and more prevalent as we go. But nevertheless, whatever caused it, we damaged the charts, right? I mean, this was a $1.50 or $2 collapse in November soybeans in a 5-day period with zero fundamental change. And so whatever it is, it happened, and here we are. And I think the market's trying to decide whether it needs to go higher now or whether it's going to give itself a little bit more time, because the reality is we don't have any beans. If our carryout was 150 million, China just bought 10 cargoes, which that's 80 million bushels. So our carryout was 150, right? Now it's a lot less than that because we sold it. And there's rumors floating around that they bought 10 more yesterday. So there's potential that they used this decline to get the rest of our beans. And if that becomes true and we get into weather issues, it's insanely bullish. So let's look at the corn chart because it's scary too, right? And we're under pressure a little bit here this morning. We've had a massive volatility. Here's the day here's that last Thursday. We turn it around with a big, nice reversal piercing pattern here on Friday. Monday really traded pretty well, and then yesterday we're off on the massive rain weather or massive rain forecast for Iowa. So I think what's happening here is we've just got incredible volatility, which we knew was coming, and we have just a lot of uncertainty, right? Is the inflation trade gone? Is the Fed going to step in and try to hurt us? Is the is something bad going to happen? And I think what we've got to do is take a step back and realize that corn is getting chopped up. It's in a sideways move because it is trying to figure out just how short its supply is. But corn has not gotten into ration mode yet. The ethanol industry, everything expanded its margins. The market did its thing, and it allowed producers to grow to grind corn, sell ethanol, and make $1 a bushel. That's mind-blowing when just 2 years ago we couldn't even withstand $4 corn. So I think the best thing that we can do is drill in and focus on our weekly charts, and we've got to realize what's happening is that we are in steep uptrends. We're playing a very high stakes game, and we're getting ready for pollination. So there's a lot of fear and a lot of volatility getting banged around in here. But if you look at the weekly chart, right, we haven't done anything to cause any damage here, even with this massive volatility that we had last week. And so I think it's really important to keep focused on what the what ifs are on the balance sheet. Okay. And so I've got the cases laid out down here. If we add 3 million acres next week to the corn balance sheet, and we yield a 175, which most analysts I think are now trading somewhere around this number. I think this is what we're trading: 2.5 to 3 million increase and a yield of about 175. I don't think that we're trading the demand number. So I think that we're trading a balance sheet somewhere around what the USDA says we have, which is a 1353. Maybe we're trading a little bit extra demand because remember, ethanol is strong, exports are strong, and everything about the corn demand side points to the USDA is too low on its estimates, not high enough. And so here we are sitting with a 3 million acre increase and a potential balance sheet that comes in only at $1 billion. Well, the difference is that when you put in your corn ratings and you kind of run them through the models and you track it by state where the production is and all this stuff, this rain coming is like do or die. Iowa's got to get it or we have major problems, because the yield model that we are using is showing us at a yield of just under 170. And with a 3 million acre increase in the demand where it's at, that puts us at a 200 million bushel balance sheet, which can't happen. That's too tight. So at some point here, corn is has got to make a decision that it's got to ration itself out, or something's got to come to light that says no, we don't have a demand problem. Our yield is what they say it's going to be. So we really have a bigger carryout. Something's got to materialize that points that direction, or we've got to go much higher, because this is too tight. And coming into pollination, you gotta assume that the futures market is going to price some of that in at some point in time. So what we've been talking about is, with as big as swings as we're having intraday, you really got to just pick a team, and you got to pick a team and you got to stick with it, because this chart is really bullish, and we could be above 660 and in the new highs in 2 or 3 days. This can happen so fast, you're not going to have time to get back in it. So let's talk strategy here for the last 5 minutes. I think today's a really important day, and I'm going to show you why real quick. This is the weather information as of this morning. Okay, this is your GFS. This is the European ensemble, and to make it clear what has happened over the last several days is the models have trended wetter. So you've got activity down here in the Gulf that's kind of pushing moisture up. But what happened this morning on this model is that it actually started pulling the moisture further east. And if it continues to do that and these other models confirm, what that means is that we're taking the moisture out of central Iowa, which is where we've got to have the moisture more than anything, because it's running such a severe deficit, and it's such an important part of our production system. So we've got great crops to the east, we've got dry crops to the west. Iowa cut it in half, and the eastern half is part of the east side, and the western and northern half is part of the dry side. And if these rains don't materialize, then there's a major problem. So I think we've got to let it trade through today to see how that materializes and see how the market reacts. I've kind of got my eye on this between 530 and 520. I'd like to see that level hold corn before we take evasive action and pick up some protection. If we pick up any protection at all, what I'm going to do is pick up short-dated August puts. They're relatively inexpensive. They buy us coverage for the next 45, 50 days until we know what our crop is, but it leaves our upside wide open. I think that would be the play rather than selling cash or selling futures or anything else, because if you sell cash, the options are pretty expensive. If you sell futures, you limit yourself and you reduce your upside. I would much prefer to have short-dated puts, just to get protection out of this what-if event and let some of this fear and some of this stuff get kind of priced in and moved to the sideline, so that we can go back to trading. I think what's coming, which is much, much higher prices for everything. So even in spite of this action that we've had here, nothing's changed on the balance sheet. And if you get nothing else from here, there is no data from exports or from weather or from acreage. There is no new information that we don't already know that would argue that our carryout is going to grow or exceed or come in excess of what the USDA says it is. Now, will they come in and print a stupid number like oh, hey, we don't have any demand, we planted all the acres, and we're going to a 1.7 on our balance sheet? Well, let's think that through. If they do that, we know that's not true, because the actual information that they're using is higher than that. So they to print a number like that, they would have to be intellectually dishonest, because that's not the data that they're giving us. And then if they do this, what happens? Well, we get a big knee-jerk reaction, and China's going to come in and buy it all because they still don't have any stockpiles. So so I don't think that that's really going to be a huge risk. I mean, it can happen. Who knows what the USDA is going to do? They've certainly not been the producer's friend over the last 7 years, but maybe maybe they'll actually be honest and tell us what we all already know is to be fact. So we'll see. So this would be why you would buy short dated puts, just in case they did something silly like this and the market's got to go react to it. But I really think we're more getting ready to trade towards this column than we are even towards this column, just based on what the setup is. But we got to get through the weather. We got to get through the will it rain, will it not? We've got to get through all that first. But I really believe the best case is just to stick with the bullish case, because the upside far exceeds the downside risk as of today, and all these other shenanigans that are happening is just some of the volatility that we've been expecting. So I'm going to say it again to end: patience, patience, patience is what's required in this game, because this story is way, way far from being over. All right, that's my full 20-minute allotment. I didn't get wheat covered. I guess I'll just say it looks like it's starting to divorce itself from corn and start to work higher, which is good, and that's also bullish corn as well. So I think a lot of things are starting to point to this sideways chop is ending. Remember, there is risk in trading futures and options, and if you're going to trade, you've got to do so in light of your own financial condition, and you should work with a professional to help make sure that you are guiding by your own principles. We would love the phone call. We're happy to help anytime. I hope you have a great day. We will talk to you next week.